I'm here with Eduardo Garab. Ed and I are the authors of the mid-year update to our annual outlook, which has just been released. You know, we released the global chapter of our annual outlook back in mid-November, just before a wave of euphoria really swept the real estate market as bond markets started to price in up to 4 rate cuts for 2024. And so this expectation that substantially falling interest rates would bail out a lot of investors. And we worried. We looked back at our outlook and we said, this isn't going to age well. But, you know, 6, 7 months later, in fact, what we see is a landscape that bears an uncanny resemblance to what we wrote about in November. And it's not because nothing's changed. It's because the market has gone full circle. Inflation has proven, particularly in the US, to be stickier than many had hoped. Those Fed cuts, rate cuts, have been pushed out further into the future. We have kept using this metaphor of a hiker going in the mountains as we have talked about rates, the steep ascent, walking along the ridgeline but not really going anywhere, sudden upward turns. I think the most important lesson from that metaphor is that our hiker doesn't have a map, so we don't know which way the path of interest rates is turning at any point. And actually, as real estate investors, um, you know, we don't have a unique advantage in predicting bond market movements. It's very, very difficult. We should spend most of our efforts figuring out where there is value within real estate. Um, but it is the case that kind of euphoric period that we had at the end of 23, beginning of 24, has come back to an expectation of relatively higher for relatively longer, which is more consistent with what we wrote in the annual outlook.
Yeah, maybe to extend the hiker metaphor, really there's more than one hiker, and not a single one of them has a map. I think one of the themes that we allude to quite significantly in the piece is the reemergence of divergence across the macro underlying picture in many parts of the world. I think were you to look back 6, 12 months, the story was much more homogenous about falling rates, cooling inflation, etc. But we're actually starting to see some countries deviate from that, or at least slightly, at least in the short term. For example, we've seen the ECB and the Bank of Canada cut rates very, very recently. We're still waiting for the Fed to do the same. Uh, we're not sure how long that's going to be, but market expectations of that continue to fluctuate. Um, and then you have the remaining two countries that have been standouts for some time, like Japan and China. But that divergence is reemerging, and I think what we need to be intelligent about is deciphering that and understanding what the implications are for investment strategy.
Some of the other divergences we're monitoring are in the property markets. We see a revival of cyclicality, renewed cyclicality in property market fundamentals. We use the phrase in the annual outlook, coming off the boil. We're seeing that hot sectors, preferred sectors, we're seeing cooling fundamentals. That cooling has continued. We now have outright rent declines in some of what had been some of the hottest U.S. apartment markets. Uh, um, and so there's some pretty substantial short-term challenges in property fundamentals that had once been in really high flying. But we would encourage investors to look through the short term to the medium and the longer term. Part of this softening is due to post-pandemic normalization, but a lot of it is due to a wave of supply. That wave of supply, these properties that are being completed today, the decision to put the shovel in the ground was made 24 months ago or earlier. It was a very different environment then in terms of reasonable expectations about exit cap rates, construction costs. The reality is that the development math, in many cases, doesn't even pencil anymore. So we see a sharp fall off in construction starts. So the kind of moderation of these issues is already, we already see the conditions for that. And we see strength on the other side. So the phrase that we're using in the mid-year is ride the supply wave. And we think investors should be prepared to to stomach this kind of period of renewed cyclicality that we're seeing.
Moving on from cyclicality, I think you mentioned that investors should focus on the medium and longer term. I think they also should focus on the longer term, and that's something that we speak about a lot. And it's thinking about secular changes in the way that we interact with real estate. And in the mid-year update, what we really highlight is two polar opposites of that secular story. On the one hand, we think about a rebalanced retail sector where, acknowledging the huge variety of subsectors of retail that exist, we have seen a major shift in the supply-demand balance of that market over the last decade or so, where either through demolition or the obsolescence of non-viable retail schemes, we've seen a rebalancing of that sector, a massive fall in rents in many parts of the world, and really with that dynamic of repricing, rebasing rents, and resizing of the stock, we are actually starting to see selective attractive opportunities in the retail sector. Now, the other sector that's very interesting from a secular change perspective is the office sector. It's perhaps at the start of a similar change that the one that retail saw 10 years ago, but it is very mixed. So, for example, you have um, some some parts of the world, like Korea, for example, Seoul, where vacancy rates are super tight, the market is actually seeing rents rise. And then on the other hand of on the other side of the spectrum, you have markets like North American office markets where you have double-digit vacancy rates and no real prospect of those falling back immediately. And then you have Europe somewhere in the middle. What that really means is that the office landscape is a little all over the map. And um, in addition, what you see is also this increased dichotomy between the best quality office space and the worst, particularly in places where conditions are much tighter, like in Europe, for example.
We conclude the piece with looking at some of the past experience of cycles, and applying that to today. And one of the things that we find is that in moments of elevated volatility, pessimism, uncertainty, but also when there's signs of improvement and turning a corner, that those are the best times to invest. The trouble is, it's very hard to pinpoint that moment in time and to really call the bottom. And so, our perspective is that don't wait for the all clear signal. The all clear signal is too late. The current period is likely to be in a good vintage, but in this piece, the title is actually a reference to the Matrix. Choosing the blue pill over the red pill, or actually choosing the red pill over the blue pill. The blue pill represents um, kind of continuing to live in fantasy land, and the red pill means accepting the market, accepting the world for how it is, and seeing that. And red pill thinking um, requires realism about where interest rates are headed. A V-shaped recovery in property markets would be predicated on central banks introducing ultra accommodative monetary policy like they did after the GFC, and that's just not something that is highly likely today. Red pill thinking requires being realistic about the short-term property fundamentals and pricing that in, but seeing through the wave of supply. So those are some of the themes in our mid-year outlook. We hope you have a read if you want to look at the full document or the accompanying macro deck, the Lasalle Macro Quarterly. Just go to the Insight section of lasalle.com.